So easy, so easy. So easy, so easy.
Good day, everyone, and thank you. Welcome to this webinar with ETF Equities and Satrix. Thanks so much for taking time out of your day to join us today. As Nico said, my name is Sean Keeling, and I'll be your host. And today we're joined by Nico Katzke, the Head of Portfolio Solutions at Satrix Investments. And we'll be chatting about the Satrix Capped All-Share ETF, which lists on the 10th of November this year and is currently in IPO stage. And the IPO ends on midnight on Thursday, the 28th of October. But you'll hear a little bit more about that just now. It's always a really exciting time when a new ETF lists on the JSE. We currently have 85, and with this new ETF, it'll be up to 86. And it's also really lekker for Satrix, because Satrix, it'll take their ETFs a number up to 23. So they have a big bunch of them on the JSE, which is also really lekker. If you are looking for a recording of this webinar afterwards, please visit our webinar page on Easy ETFs, where it'll be recorded. And please feel free to ask any questions that you want during the presentation. Please make sure you put them in the question and answers box at the bottom of the screen, not the chat box. It's much easier if they're in the question and answer box. Over to Nico, and thanks again for joining us today, Nico.
It's a pleasure, and thank you for your introduction. Let me just get my screen shared. You can tell me if it's coming through.
Yeah,
certainly coming through on my side.
That's it.
Thanks, Sean. Yeah, and thanks for the introduction. I think it's really exciting for us to bring another first to the market. So Satrix has always been a pioneer, I suppose, in the space of providing the market with new ETFs. And certainly in this case, we are bringing something new to the market. So please, I want to just echo Sean's sentiment there. If you have any questions, I mean, we're happy to entertain that and to have this discussion be robust. And it's a fantastic time to be introducing the Cappy. It's been a long time overdue, I suppose, that we are providing the market with a truly full market replication index, sort of a broader exposure to the entire market. So you all know that the Satrix Top 40 Index and many other ETFs that provide you with exposure to the market, but that's typically a subset of the market. But what we're offering today is a broader index that provides you a sort of a broader base of exposure. So apologies if my screen is a bit bright, so I might all of a sudden look like I became a ghost. But just some quick fun facts about the Cappy index. So it is the Capped All-Share Index. We call it the Cappy. It is the first ETF to track a full universe of large, mid, and small cap stocks. It gives exposure to 143 stocks in total, the index, the Cappy index, of which about 20% exposure is to mid-cap stocks and about 5% exposure is to small-cap stocks. And I hope you're going to find it interesting when I break down actually what this 5% constitutes and what the 20% constitutes and the different return profiles that these different groupings, if you like, of mid and small caps are adding to your portfolio. So in other words, it offers a broader scope and more diversification than existing market tracking indices, specifically if you compare it to something like the top 40 or similar variants. It just offers a much broader scope for exposure as well as diversification. So as Sean mentioned, the IPO started on the 18th of October and closes on the 29th. So it's a great time to seriously consider adding this to your portfolio. Also, just as a sort of an additional selling point, we offer a 0% TER. So we've waived all fees until the 1st of June 2022. It's seldom that you see a zero fee exposure to equity markets, so definitely take advantage of this. If you do buy ETFs as part of your investment, or you buy into ETFs as part of your investment philosophy, this is a fantastic one to introduce into your suite of portfolios, and we truly believe it's adding value to our clients. Now, let's first look at what you are getting when you are buying the Cappy index. So what this slide is showing you, it shows you that, well, let's first focus on the top 40 index. And maybe with that, we are able to give you some Sorry, I just need to move that. We will be able to give you some idea of what the Cappy is providing you that the top 40 index is not providing you. So I suppose most of you will be quite familiar with what the top 40 index constitutes and what it gives you. But I just want to contrast the Cappy and the top 40 very quickly. So the top 40, what we can see on this screen is that it gives you a nice distribution of about 45% exposure to industrials. You can see that the size of the company's name, that gives you an indication of the size of the company in the portfolio itself. And there in the bottom right, you can see the weight that is, or the weight exposure that you have to the different stocks. So you can see that roughly about 45% is this blue area there, gives you a nice industrials flavor, which includes household names like Naspers, Richemont, Billiton, Mondi, Process, MTN, Vodacom, as well as retailers like ShopRite, Clicks, Woolworths. It gives a very nice spread of sort of the companies that you know, that you go to buy your groceries from, etc., etc. It also gives exposures, investors good exposure, about 1/3 exposure to global resource and local resource companies. This includes good exposure to BHP, Anglo's, Goldfields, Impala Platinum, and of course Sasol as well, with these companies typically providing quite a nice rand hedge to your portfolio. So overall, about 1/3 is allocated to resource companies. You also get about 1/5 or 20% exposure to financials, and this includes all your large banks and financial institutions that you can see there at the right: First Rand, Standard Bank, Capitec, Sanlam, ABSA, Old Mutual, Nedbank, etc., etc., and the list goes on. So about 20% exposure to those. And then you also get some exposure to property companies, namely 2 property companies that you have exposure to. And that's generally oscillates between 1.5% to 3% exposure through time. So in all, the top 40 index provides you with a good balance between both multinational as well as local companies that have proven over time to be incredibly hard to beat this return profile from an active management perspective. Now, if we look at what you are getting in addition to the top 40, when you hold the capped all share index, so the Cappy, you can see this figure expands quite dramatically in terms of the exposure that you're getting pick up to. So you're getting roughly 100 more companies in your portfolio while maintaining your exposure to your large multinationals. So I think I just want to sort of at the start say, while you are getting more exposure to mid and small cap stocks, the bulk of your portfolio is still focused on the large cap stocks, so the large names that you're well accustomed to. But from our perspective, we believe that it's adding quite a lot of value to clients due to this increased exposure to smaller and mid cap stocks. Like you're getting there, quite a nice pickup to industrials on the smaller cap side. And generally, the sector distribution comparison between the top 40 index and the Cappy is quite similar. Largely, the big difference there is that you get quite a bit more exposure to the property index in South Africa. And we believe that that can be quite, or is quite a nice addition to the portfolio for most investors, because in our estimation, there's quite a bit of upside still in the property sector locally. Now, if I just change the shading a bit to give you an idea of what you're getting that the top 40 is not providing you, it is the areas in green. So you can see that you get quite a nice widespread of industrials there. Quite a few names are added to your portfolio, your Fushinis, etc., etc., and then also quite a few resources added. And like I mentioned, I mean, the difference between the two would be that you're getting quite an increased exposure to property companies as well. And of course, on the financial side, you are also getting quite a few mid to small cap names. So interesting just to sort of compare the two. If I flick again through the difference between the top 40 index and the Cappy, you can see you're getting a much broader exposure to companies in the local market. So before we go into the performance comparison, let's maybe break down what you are investing in with Cappy in terms of a size breakdown. So the top 40 index is mostly large caps, as I mentioned, although you do get some mid-cap exposure. I think it might be confusing for some, that specifically those that have been in the market quite for a longer time. Typically or traditionally, back in the day, we called anything, any company that's within the top 40 index, we termed that large caps. But more recently, of course, there are some large cap companies that are not in the top 40 index. So some large global names, for example, that are large companies, but they're not in our top 40 index. Okay, so, but the bulk of your top 40 index comes from large cap companies, about 90%, and about 10% exposure generally over time is to mid cap companies. If we now look at what the Cappy offers, the Cappy compared to the top 40 provides a healthy exposure to mid and small caps, generally varying between 15 to 20% mid caps and then about 3 to 5% small caps over time, as you can see there. Most recently, the Cappy gives you an exposure of about 75% large caps. So again, 3/4 of your portfolio still the large cap companies, and then currently about 20% mid caps and roughly give or take 5% small caps as well. So this means that if you like, the meat and potatoes in terms of exposure lies within the trusted and highly liquid large cap space, while providing you some spice to your dish, if you like, in terms of smaller company exposure. And we will get to what this means for your portfolio as a whole, but we believe this additional exposure to mid and small caps is on the whole is a good thing and should be prized both from a diversification potential as well as potential upside that you're getting. And you can see that you're very well diversified, specifically in the small cap. You hold about 60 odd companies within that small cap grouping. So even though it only constitutes 5% of your portfolio, it's a very well diversified 5%. And remember that that's the part of your portfolio that you would like to have increase your diversification because generally small caps can vary quite a bit more. But we'll see on the whole, the group actually shows less variation towards the end. Now, in terms of sector exposure, the top 40 index, as I mentioned, and the Cappy is quite similar, with the only meaningful difference really being the property exposure that you see there at the bottom in purple. But by and large, you're getting quite similar sector exposures, and you can see through time, it ebbs and flows. Currently, with resource companies having rebounded quite a bit since a large sell-off in resource companies, we see the exposure currently about 1/3 in the top 40 index and about 45% industrials. For the Cappy, same, about 45% industrials, slightly lower exposure to resource companies at about 1/3, and then 20% financials companies, and roughly about 3.5% property companies. So now, it's also interesting to look at what type of company exposure you are picking up when investing in different indices locally. Because I think when you're looking at sectors, a lot of you might think, well, you know, what's the difference between industrials, financials, resources, etc. But it's interesting to take a higher level, sort of a bird's eye view in terms of what you're getting. So on this slide, we compare the all-share index as well as the SWIX methodology in terms of where they are deriving their revenue from. Now, there are clear methodological differences between the all-share and the SWIX floats, with the SWIX having a significantly higher weighting to local companies that derive most of their earnings actually locally. This follows as a SWIX considers local stock float when arriving at its weights. Now, the Cappy, which is the cap variant of the Aussie, actually gets quite a high pickup in terms of foreign revenue at about 63%. Now the Cappy, which is, there's also a little difference in terms of cost. So the price earnings ratio between the Aussie and the SWIX variants also quite similar, 10.5% to 11%, and 10.5% and 10.5% for the Aussie and the Cappy. Now, just in terms of performance, yeah, I want you to just look at the slide. It can be a bit busy, but I want you to just cast your eye in terms of the performance of the Cappy that you see there highlighted in blue compared to different indices. So the SWIX index, so in other words, the more local flavor or the SA Inc. type flavored index, getting quite a bit better return over the last 12 months. But if you look at it on a 2-year, 3-year, and 5-year basis, actually your Aussie and your Cappy indices have performed quite a bit better than your SWIX and your capped SWIX alternative. So the Cappy has delivered incredible returns on a 12-month, 2-year, 3-year, and 5-year basis. In fact, if you compare that to the active industry median, so in other words, the median active manager in South Africa, you stack up the performance that these managers have delivered over time, you can see that the Cappy has comfortably outperformed the active industry as a whole over a 2-year, 3-year, and 5-year basis. In fact, on a 5-year basis, on an annualized basis, the performance of the Cappy is roughly at about 7.5%, and that of the active industry at about 4.5%. So quite a sizable difference there in terms of performance. The last 12 months, the Cappy has underperformed slightly the active industry median, and we'll get later into why that's the case. And that's largely because SA Inc. companies have really done well the last 12 months. In fact, if you look at the breakdown, the comparison, how well the mid caps and the small caps have done over the last year, this gives you an indication of why specifically your more SA Inc. type companies, which is dominated by your small caps, have done so well. So the all share index, again, relative to the SWIX variant, I just want to highlight again, and this can be confusing, so it may be beneficial to say again, the all-share index upweights global companies, whereas the SWIX index downweights global companies, right? So SWIX only looks at what is on the local float, whereas the all-share index looks at what's on the global float. So from that perspective, because small caps and mid caps have done so well over the last year, it stands to reason that these companies, most of them are more SA Inc. type companies, and as a result, you will see your SWIX type indices do very well, as well as your active managers that have a higher pickup to your SA Inc. names tend to do a bit better. But on the whole, as I've stated before, the performance of the Cappy and as well as the all share index, in other words, that has a higher weighting to your global type companies, they have done very well over the 3 and 5 year period. So how well? Well, let's look at it. I think a picture paints 1,000 words. So on this slide, what we're doing, so I'm just going to carefully explain what's going on here. Here we compare the rolling 3-year performance of active managers in the ASISA general equity space. So these are all your well-known household name active equity managers, comparing their performance relative to the Cappy. Now, the zero line that you see there is not telling you that they earn zero returns. That's we simply put the median active manager on the zero line. Again, the difference between a median is effectively an average or similar to an average, although an average outliers tend to affect the average, whereas for a median, it is, it's just taking, literally it's ranking all the active managers and taking the middle part, the mid part. Now, if you look at the mid part for active management over time in South Africa, that's a zero line. The dark blue lines, those are your top and bottom quartiles, and the light blue lines, that's your top and bottom decile. In other words, top 10% performer and bottom 10% performer there at the bottom. Now, if you compare this to the Cappy index return over time, and here we do, just before you shout at me, we do take a 30 basis point fee and trading cost out of the performance of the Cappy index to put it on equal footing. Of course, and we can discuss that, but ETFs generally provide you with a much, much lower cost profile, both in terms of trading costs as well as management fees generally than the active managers do. And it stands to reason that that would put us in terms of, on the front foot in terms of providing you with outperformance. But if you now fee correct the Cappy, what you can see is very few periods actually on a 3-year basis do we see that the Cappy underperforms active managers on the whole. In fact, you have to rewind all the way back to 2011, 2012, the last time that on a 3-year basis, the Cappy underperformed the median active manager. Now, these are incredible numbers because it shows you the consistency of performance that the Cappy index is providing you and how incredibly difficult it is for active managers to deliver outperformance to a well-diversified index like the Cappy. That gives you very good offshore exposure pickup. In fact, in recent years, it's been particularly hard for active managers to outperform the Cappy due to its large exposure to companies that derive the majority of their earnings offshore. So most active managers cannot replicate the Cappy to the same index as we can construct it, and so have to downweight their exposure to companies deriving their earnings offshore. So if we compare, in fact, the performance to the top 40 index, what is interesting is, and I think this initially when I created this plot and I looked at it, I was a bit taken aback by how much more stable the Cappy's returns have been relative to the top 40 index. Remember, the Cappy contains about 100 additional stocks that's not in the top 40 index, and these generally are mid and small cap stocks. And historically, we tend to think about small cap stocks as being more volatile. So you'd think that the return profile of the Cappy is more volatile than the return profile of the top 40 index. But what I'm going to show you in a few slides is that actually the diversification benefit that you're getting within your small and mid cap stock ranges are such that it actually lowers your overall portfolio volatility and actually leads to smoother returns over time. So you can see there's quite a few periods where the top 40 index underperforms active managers, and then periods where the top 40 really shoots the lights out. And you can sort of look at this region that I'm highlighting there, particularly containing periods where Naspers, for example, and Richemont delivered exceptional returns and have really outperformed active managers that cannot hold exposure to those companies to the same extent. The Cappy, again, a bit more moderate, so less deep drawdowns, but also less sharp upticks due to it being more diversified. And the more you diversify, logic should dictate, the more stable your returns are going to be, but also the less extreme upside you're getting. Now, if we, just to give you a sense on a 12-month basis, because generally in our industry, we look at a 3-year basis as quite important. So that's why I say here it's rolling 3-year performance. But if we look at it on a rolling 1-year performance, it gives you a sort of short to mid-term view of the performance of the Cappy versus other indices. We see that the Cappy's performance relative to the top 40 index. Now, again, the 0 line, that doesn't mean 0 return. That is simply scaling it to make the Cappy's return 0. So that we can see anything above the line, that's an outperformance, and below the line, that's an underperformance. Now, what you can see here on a rolling 1-year basis, there are times where the top 40 index outperforms, and there's times where the Cappy outperforms, and it sort of ebbs and flows, right? But what I want to get to is why are there periods of underperformance like we see more recently over the last year? Why has the Cappy actually done so well relative to other indices on a 1- and 3-year basis? And what's driving that return? So if we now start to superimpose what you're getting, remember you're getting quite a bit more exposure to mid caps and small caps. Let's look at what the mid caps and small caps have done recently. So the blue line, that's your mid caps, and the red line, that's your small caps. Now on a rolling 12-month basis, you can see that this underperformance that we see there for the top 40 index relative to the Cappy. So in other words, the Cappy's strong performance last year has been driven mostly by very, very strong performance in small caps, as well as a strong recovery in mid caps. So following sort of tumultuous time in equity markets globally in 2020, there's been a very strong rebound, and small caps and mid caps have been the companies that have benefited the most. So that's why we see sort of more recently that the top 40 index has lagged the performance of the Cappy. It's underperformed. And over time, you tend to see that there's periods where the mid and small caps have a very high return relative to the Cappy. Now, of course, the next question is, well, you're getting more exposure to the mid caps and the small caps, but really, what's that giving you? Is it giving you more diversification, or is it not giving you more diversification? Now, this is quite an interesting slide because it looks at the rolling 12-month average correlation between companies in the large cap, mid cap, and small cap indices. And this, I must say, was quite surprising to me, because if you now look at the last 10 years, and every month you look back 12 months and you calculate the average correlation between large caps, mid caps, and small caps, that gives you a number every month, right? And we calculate that number for the last 10 years, that now gives us a time series of correlation, of average correlation between large cap stocks, between mid cap stocks, and between small cap stocks. Now, if we draw a distribution of that, right? So where it has a fat tummy that is saying that the majority of times large caps on average are about 20% correlated to one another on a rolling 12-month basis. So in other words, if you look at the last 12 months, how correlated are they? Roughly about 20 to 30%. What's fascinating, though, is that within the small cap range, we see the correlation between returns is much lower. So in fact, on average, well below 10%. So that dot is the 10% line, or is the average correlation. So we see actually, I suppose, contrary to at least my prior beliefs, is that there's more diversification potential amongst the small cap stocks than there is amongst the large cap stocks. And I suppose this follows largely because large cap stocks are dominated by multinational companies, many of whom derive their earnings offshore. Now, while this provides you a very good rand hedge, and we strongly believe this is a great addition to your portfolio, this means also that changes in global sentiment and economic activity affect these stocks directly and quite comparably over time. So that means if there's a tumultuous time overseas and you see economic activity decline, for example, you see your large cap stocks all sort of behave similarly. Whereas for the small cap stocks, most of their returns are derived from company specific information. So less so global information, more so company specific information. So that means if you are well diversified across a range of small caps, you're actually getting higher diversification than only investing across the large caps. Well, now, of course, the next question would be, well, what about returns? Now, interesting, the mid caps and the small caps, again, if we do the same thing on a rolling 12-month basis, every month we look back 12 months, we calculate the average return, and then we move that forward, then you see that the small caps, as to be expected, gives you a much wider return profile. And generally, this distribution is towards the upside. So in other words, while you are getting your meat and potatoes from the large caps, you're getting quite nice dose of spice to your dish from exposure to the small caps. And we believe that this increased diversification, as well as exposure to the potential upside of your mid and small caps, is really something that should be prized in your portfolio. Then lastly, in terms of risk, it's also interesting to note, sort of in closing, and I promise I'll be done after this one, Sean, is that this increased upside and higher diversification provided by increased exposure to mid and small caps does not necessarily come at higher portfolio risk. So again, contrary to popular belief, if you look at the distribution of risk, again, annualized risk compared within your small cap range, as well as your large and mid cap range, we see, and we saw this over the last few years, that your small caps have generally shown to be less volatile than your large caps and mid caps as a whole. Again, the index. There's more stocks in your small caps than in your mid and large caps. So again, giving you upside potential, more diversification, but not at the cost of increasing your portfolio's overall volatility. And we think the combination of higher diversification, higher potential upside, but not at the cost of necessarily higher portfolio volatility, we think the combination of that is adding tremendous value to your portfolios. And so we believe this Cappy index or Cappy ETF is something you should strongly consider. And of course, I mean, do I need to repeat that? With a TER of 0% until next year, June, it's certainly a bargain you cannot afford to miss. So with that, I'll hand back to you, Sean, and happy to take any of your questions.
Thanks so much, Nico. I always like a deep dive into data and understanding it more intensively. So that was really like it. So thank you for that. And that's really interesting about the TER. I didn't know that before. And so really like it. And I just wanted to find out why did you guys decide to do that before we dive into the guys' questions?
Look, it's almost Christmas. I mean, we had to give you something. No, we just want to create a bit of a splash behind this IPO. We think, again, Satrix is at the forefront of innovation. We were the first to provide you with an ETF, the Satrix Top 40 Index 20 years ago, more than 20 years ago. And we're the first to provide you with a full broad market exposure ETF. So just celebrating the fact that we're again at the forefront of innovation, we are offering you a zero fee portfolio up until June 2022.
No, that's really awesome. And with the IPO, and just a reminder that ends on Thursday midnight on the 28th, if anyone is interested in that. Yeah, thanks, Nick. I see there are some questions here, so if we can dive into them. And if anyone has any more questions, please just pop them in the question and answer box. No worries. Can you see the questions there, Nico? Sorry, what is the ticker name on Easy Equities? So I'm not sure on Easy Equities, but I think it's going to be STX CAP, so CAP. I'm not sure what that's going to be on your platform. Yeah, be the same. STX CAP for the Cappy. And again, I just want to say it's the capped all share index, and there is that difference between the SWIX and the all share index that I explained. And of course, if I didn't do a good job of doing that, you're more than welcome to just ask me to again elaborate on the difference between the two. There's a few there in the question and answer box, Nico, if you can dive into those ones also, please?
Sorry, I did not. If you don't mind reading that for me very quick there, Sean.
Perfect.
I can't see that box.
So our first one says, what drives the percentage allocation into these companies?
Yeah, so this, I mean, the allocation, we don't decide upon ourselves. It's not something that we provide or that we apply discretion on. This is simply how the market prices these assets. So the different weights that you have, specifically for the capped all-share index, how that will be arrived at is it's a combination of the price of the company, the size of the company, so in other words, the shares in issue, and if you multiply the two, you get a market cap. And then for the all-share index, you look at the global float, depending on, it gets a bit technical, but your grandfathered companies, so in other words, companies that were South African, but then moved their primary listing offshore. There's quite a few of those names. But depending on that, you look at the amount of shares that is outstanding in the market, in other words, that you can actually go and buy, the price of those shares and the amount of those shares. And if you multiply them together, you get the market capitalization, in other words, the size of the company in the index. And then we simply replicate the index. So we provide you exposure to the index as a whole, where the weights that we allocate to the different companies, as you can see, they're 9.4% to BHP, 9.3% to Richemont, 7% to Naspers, etc., etc. These weights are purely determined by the size of the company within the index. So I just want to reiterate that this is not our best investment view necessarily, or that we are, favoring Anglos relative to Sasol, for example. It's simply how the market prices these companies. And what index tracking ETFs really tries to do is it tries to give you exposure to the market. Now, how we define that point, the market, I suppose there's different ways that you can do that. You can, for example, equally weight all of the companies in this index. But the problem with equally weighting them is then you get very high exposure to these small companies, right? And a small company on the all-share index might be much more volatile than a large multinational institution that's been there for 100 years and will probably be there in 100 years. So you're getting more exposure to the larger companies. And we believe, that's a better reflection of the market. So when we say we give you exposure to the market at a low fee, we're doing exactly that.
Perfect. Thanks, Nico. The next one we have here is asking, what will the TER be after June?
25 basis points, so 0.25% after June. So until then, you get 0% TER. That's our management fees, and I mean that's a great deal. It's not often that you see you get zero fee exposure to equity markets. So yeah, after that 0.25% TER. And again, that is extremely aggressive in terms of fees, aggressively low, if you like. And specifically, if you're a retail investor, if you're a client of Easy Equities, you buy different, you are able to invest in different retail, actively managed retail funds, as well as different ETFs. I mean, if you weigh up the fees that you're paying for the different alternatives, you'll see that 0.25% annual TER is quite low. And again, that's adding benefit to our clients. We truly believe in democratizing investments, so making it easier for you to invest your own money and be conscious of fees. I cannot stress that enough. It's a mantra that I live by. Is control that which you can control, and fees is one of those things with investing that is within your control. You can manage that. You can invest in funds that charge a low fee. And over time, fees tend to compound against you. So if you're investing for 20 or 30 years and you're paying a high fee, that really works against you. It becomes really hard to justify fees if you look at this slide for how well the Cappy index has done relative to active managers after costs.
Thanks, Nico. We have quite a few questions asking about the different investing in the Satrix 40 compared to this new Cappy. And I mean, of course, we can't give advice, but I mean, maybe why would you pick either of those, and why would people want to change into the new one?
So I think there's merits in holding both, and that's quite an interesting. That's a great question, by the way, because ultimately we also believe in the top 40 index. It's been a staple of ours for the last 20 years. It's won many awards, and it's a favorite of our clients, and it's giving you great exposure to those large cap companies. So what you see here is, if you look at the top 40 index, compare that to the Cappy, you're getting about 87 percent or closer to 90% over time exposure to large caps. Now, what the Cappy is offering you is this additional exposure to the mid and the small caps. And what we believe is that it's not necessarily an either or. We think there's value in combining both of these strategies in your portfolio. It's not that the one is cannibalizing the other. It's simply that the top 40 index is more concentrated to the large cap companies, the well-established, highly liquid companies that have always been there and will continue to be there. You're getting that at a very low cost exposure to them. But what the Cappy is adding to that mix is just this spice, if you like. And we take comfort from the fact that the meat and potatoes still coming from the large caps, but you're adding the spice there in terms of your mid and small caps. Just in terms of the tracking error to SWIX. So you've asked relative to top 40, but if I can just also again say relative to the SWIX, it's actually offering you something quite different compared to the SWIX index as well. So a lot of these different strategies, they're not the same thing. In fact, recently shown on research that we presented at a few conferences, we keep reiterating the fact that not all passives are equal, not all indices are equal. There's actually value in blending them, and we believe the Cappy is providing you a good additional exposure to the mid and small cap stocks that the top 40 index is not providing you. So, I think it's a good idea to hold both.
100%. Thanks, Nico. That makes a lot more sense. And like I said, we had quite a few questions about that. We have a few questions about the dividends. When will they be paid, and about what amount will they be when they do get paid?
Yeah. So. Again, it depends. We don't pay the dividends immediately as they accrue, so you'll get them on a quarterly basis, I believe. But there we just have to be careful. It also depends what you select. So oftentimes investors select to reinvest their dividends, and that is something. The question of dividends is something that we always to clients that I always want to stress. How you build wealth over many years is by reinvesting those dividends, not cashing it out. If at all you are able to do that, I know it's tempting to take the check in the mail, to take your dividends and supplement that with supplement your liquidity. But if you're able to reinvest those dividends and elect it to be reinvested, we think that that's a long-term wealth creation strategy.
Thanks, Nico. We have some questions asking where they can find this one on the website. So it's still in IPO form. So both on the Easy Equities and Satrix Now website, if you go to the menu bar at the top of the screen and you click on that, you'll see a new listings tab. If you click on that new listing tab, you'll be able to access the IPO through that. And when you buy it at the moment, there's no random amount, but you'll get a letter of allotment, which means if you put in 100 Rand, you'll get 100 letters of allotment. And on its listing date, that will get transferred into the amount that the ETF will be there in terms of those letters into the actual amount. We have a few questions asking what the amount of the Cappy will be when it lists, Nicky, so if you have any idea.
No, sorry, that's still in IPO phase. The IPO is still open. So who knows, if everyone watching allocates more, that amount will be more. It depends. So I can't give you a round amount, the size, but yeah, we're hoping that there's quite a bit of excitement about this. Like I mentioned, because it's the first in our market, the first to ETF to offer you true broad diversification or broad exposure to the broad market. We are excited about it, and we hope our clients are as well.
I think we have a few questions. We have a few more questions asking just about IPOs and how they work and what happens after the IPO closes. So I don't know if you can dive into that also, just to explain to people after the 28th what happens in that. Yeah, so
I always fear to become too technical on this platform, and I don't think it's gonna add much value to this discussion. But broadly speaking, at the IPO, we then build that ETF portfolio that is then traded on the all-share index. It's traded as any other company, and that, so let's say 20 million Rand is allotted at the IPO. That means we then buy it according to these weights. We physically go and we buy these stocks according to the weights that you see here. That ETF portfolio is then traded on the all-share index. So you can buy it the same way you can buy BHP shares, or Anglo shares, or Naspers shares. For the same token, you can buy the ETF. So you get exposure to all of these companies by buying one share, if you like, or by buying the ETF share. Now, subsequently, when people buy the ETF, then we construct in specie more. Well, we expand that portfolio, that basket, if you like, just gets expanded. And of course, an ETF will have a market maker to facilitate that process, so that if you want to sell your ETF, there will be a buyer, and vice versa as well. So it's not that 20 million rand, let's say, that is created at the IPO remains 20 million rand over time. It has the capacity, or an ETF has the capacity, to expand and contract as well. But we can assure you is that that there will be liquidity. So if you want to sell your unit, you will be able to do so, and just do so at much less friction as well. So, but again, you know, on this channel, you've heard many times, and many of us sort of advocate for the benefits of following the ETF route. And I can't stress that enough, is that it provides you such an efficient way of investing. And for those of you that are still shy of maybe trying or buying an ETF as part of your investment portfolio, just be assured that both an ETF or an ETF is also a CIS, so collective investment scheme vehicle, similar to a unit trust. So effectively, it's exactly the same thing. It's regulated by the same regulatory authority. So whether you invest in an ETF or a unit trust, it still provides you exposure to the underlying companies. The difference being that an ETF trades throughout the day. It's more transparent, and there's constant pricing through the day. A unit trust just has pricing at the end of the day, and oftentimes you don't get sight of the holdings as you would do for an ETF like this, because you know exactly what you're investing in, and through its performance as well, you can see that there's merit in choosing this ETF to supplement your investment portfolio.
Thank you, Nico. And yeah, this is a safe investment to do then. Just tap that off. We don't have any more questions. So if anyone has any other questions, please pop them in the question and answer box. I'll give you a minute or two. Otherwise, I think we'll end it off. I mean, it was really interesting, and it's always lucky hearing about new ETFs, but like, I really enjoyed the deep dive into the data and understanding how everything worked there. So thanks again for that. I enjoyed it. I hope our listeners did also.
Yeah. And I mean, like I said, I mean, quite a few of these results are quite interesting to us as well. Like what we saw here, that you're getting more diversification in the small caps. Really looking at it carefully, we were able to identify this and see that there's quite a bit of diversification that you're getting, additional diversification when you get exposure to the small and the mid caps. So we truly believe that you're getting added value to your portfolio. So just to stress that again, these are quite interesting results in that you're getting high upside, but also more diversification. And from a pure return perspective, like you can see the red line versus the green line, it's a more stable return profile than the top 40 is giving you currently.
Perfect. Thanks, Nico. And just want to close off by saying that the IPO ends again on Thursday at midnight, and the ETF will list on the 10th of November. So thank you very much for joining us today, Nico. And thank you all of you for taking your time out today. I hope you enjoyed it, and I hope you found it interesting and learned a lot.
It's a big pleasure, and thank you for those dialed in.
So easy, so easy.